revenues, and expenses. Here today, we are discussing the balance sheet. The balance sheet, unlike the income statement, measures assets, liabilities, and equity. And so a balance sheet is measured at a point in time. So, for example, this balance sheet is measured on December 31st, 2023. And so it breaks it down into the three categories that I spoke about: assets, liabilities, and equity. The first session, or the first section, is assets. And assets are basically defined as something that you own of value. And so for lending purposes, for your own financial management purposes, you want to be able to document what it is you own of value. And so when a bank looks to lend, they want to see what assets you hold that they could possibly use as collateral on a loan. So within the category of assets, it is broken down into several sections. The first section is considered current assets. And current assets are said to be assets that are cash or easily converted to cash within a 12-month period. And so if you look under that category, we have cash and cash equivalents. A cash equivalent would be something such as a certificate of deposit. Secondly, we have short-term investments. Those could be short-term bonds. Again, those could be certificates of deposits. Accounts receivable, that would be work that was performed, income recognized, that has not been collected yet. So if you do work for individuals on account, the amount that's owed to you as of December 31st, 2003 would be representative of your accounts receivable. And next to accounts receivable, you see the word net. That would be less any receivables that are considered uncollectible. So if there's an amount that you feel like you're not going to collect, you would want to reduce your accounts receivable by that amount. The next item is other receivables. That could be something such as an employee loan. If you loaned an employee $1,000 in this case, with the expectation that that employee pays you back, then that would be considered an asset to you, and it would be considered an other receivable. Your inventory, the items you hold on hand that are available for sale, again, those would be considered a current asset. Any supplies that you hold on hand that you expect to expend over the next 12 months would be a current asset. Prepaid expenses. So a prepaid expense would be where you have paid for an expense, but you have not yet used it as of this point. So an example of a prepaid expense would be insurance, liability insurance. So normally with liability insurance, you pay for it on the front end. So if you paid $1,500 for insurance on December 31st, and that insurance was for the year 2024, it would not be expensed until the end of 2024, and it would remain on your books as a prepaid until you, or as you use it up. So insurance would be a great example of a prepaid expense. So on this particular balance sheet, if you look at it, our total current assets would be $89,000. The second category of assets that we have here would be investments. And because these investments were not shown in the current asset section, these investments would probably be considered something that you expect to convert to cash in a period beyond 1 year. Again, this could be bonds, this could be stocks, but the expectation for these investments would be to be converted to cash beyond the 12-month period. The next group of assets would be property, plant, and equipment. These assets are said to be depreciable assets, with the exception of land. Land is not what we consider a depreciable asset. So here you have land, you have improvements to land. So an improvement to land could be something as simple as adding sidewalks to your structure. It could be putting in a drainage system, but those would be considered assets under property, plant, and equipment. Your building would be considered property, plant, and equipment. Any equipment that you use in the name of your business would be another asset under this particular category. And so these items, with the exception of land, are said to be depreciable, which means they are expensed on your profit and loss statement over a period of time, which is said to reduce their book value. So these assets that we see listed here have been depreciated by $56,000. So that has reduced their value for book purposes only by $56,000. And so your property, plant, and equipment total is $337,000. I forgot to say that if there are any questions as we go through it, feel free to stop me so that I can answer those questions at that time. So thus far on the balance sheet, on the asset side, are there any questions?
Just if you could go in a little more detail on the different way that different um, assets are depreciated, because there's usually a difference between inventory and equipment and land. We don't have to go into tons of detail, but just a very high level because it's
Okay.
important to note that.
All right. So, for example, I'll go with building. Okay. Building is an asset that you purchase, but for book purposes, and when I say book purposes, reporting on your financial statement, that asset is spread over 30 years. So each year you would take 1/30th of that $180,000 and reduce the value of building. And that reduction would show up on your profit and loss statement as depreciation expense. It would show up on your balance sheet as accumulated depreciation. So for book purposes, after 1 year, that building is not valued at the 180, but the 180 less whatever depreciation has been assigned to that building. Same with equipment. Equipment normally has a different useful life, and generally accepted accounting principles determine the useful life of certain types of asset, certain classes of asset. So equipment normally has a useful life for book purposes of 5 to 7 years. So any equipment that would be recorded on your balance sheet would be expensed or depreciated over a period to 5 to 7 years. So again, in this example, we have $201,000 in equipment. So if we consider those to be 5-year assets, then 1/5 of those assets would be added to your depreciation, accumulated depreciation and depreciation expense each year until that asset is what we consider fully depreciated. And so when it's fully depreciated, it means for that equipment, we have expensed the entire $201,000 of that piece of equipment or those pieces of equipment. So at that point, for book purposes, that asset has a zero value once it is fully depreciated. that does not mean that it's not valuable to the business. But for the users, for the bank, for example, the bank is going to look at that asset and say that is not something we want to use for collateral because it is something that, for the most part, is of little value in terms of collateral. So, any further questions on depreciation on property, plant, and equipment?
Just one thing I wanted to add is I work with a lot of different businesses, and I get asked this one a lot. Um, some people try and front end the depreciation of assets, so they apply a larger amount of depreciation in year one than maybe actually happened in reality, and that can artificially lower profits, which lowers tax. Leo, you probably see this a little bit,
Sure. Uh,
and if you could talk a little bit about that.
okay. So what we have here is what we consider book purposes. So book and tax are two different uses of these financial statements. So they the law prescribes for what we call accelerated depreciation, which is depreciating an asset at a rate quicker than you would for book purposes. And just like Mr. Bigby said, it would reduce taxes in the early years, but it will cause you to pay more taxes in future years. So it is not eliminating tax, but it's deferring tax. So yes, there is a difference between your balance sheet for book purposes and your balance sheet for tax purposes. So you certainly would want to, in most cases, accelerate depreciation where the law allows you to accelerate for tax purposes. There's a section of the IRS code called Section 179. And under that section, certain types of assets you are allowed to fully depreciate in the year that you purchase them. So if that equipment, and equipment would definitely fall under Section 179, under 179 for tax purposes, if you bought $201,000 of equipment in 2023, you can deduct that entire $201,000 as a deduction in that particular year to the extent you have profit. And that would be part of the IRS code. We could talk about that in our next section that deals with taxes, but the law certainly allows for the acceleration of depreciation for tax purposes.
I have a quick question.
Yes.
I don't know if this is too overly complicated and specific to be useful in this group setting. And if it is, please feel free to disregard for this setting. But property, including like a business property, like the building, if you own the building that your business is in, you can deduct the depreciating value of the building. But if the value of the building increases, I guess that's part one. Does that affect depreciation over the 30-year mortgage? And then also, like, if you refinance your mortgage or refinance the building that you own, does that affect, the depreciation deduction possibilities as well?
Okay, very good question. For financial statement purposes, assets are recorded at cost. So any increase in value is not considered in your financial statements. So the end user of financial statements should have an understanding of generally accepted accounting principles and understand that the building that you have on these books, whether it's fully depreciated or partially depreciated, does not reflect the value of that asset on any given day. It only reflects the book value. So book value and actual value is two totally different items. So most lenders would say, we see that you have a building that you bought in 2000, I'm gonna say 15. And so that book value has reduced that asset possibly down to half of what it actually is. But a lender would ask for an appraisal so that they can make a determination of not what the book value is, but what the value of that asset is at the point you wanted to borrow money. So book definitely does not reflect the current value of most assets.
Thank you.
Oh, you're welcome. Any other questions? So the next section under assets is intangible assets. And so intangible assets are said to be assets that you normally cannot touch. They are rights. They are things of value that you cannot actually put your hands on. So goodwill is the buying of a name. So if somebody sold you a business that had some name recognition, I'm gonna say if someone sold you, I don't know if everybody's from New Orleans, I'll say the Ruby Slipper. Does everybody know the Ruby Slipper? Okay, that's a restaurant locally. So if someone sold you the Ruby Slipper, then the assets that they sell you, the buildings, the equipment, is only part of the sale. They are also want to include in their sale the name recognition that comes with that building. So when you buy something greater than the assets, the fixed assets related to that business, that difference, that value of name recognition is considered goodwill. And so in this particular situation, we have goodwill that was purchased of $105,000. And then you have other tangible assets. That could be a right. So like if you own drilling rights to an oil well, it could be a right to do business in a certain area. But those are of value, but they're not something that you can touch or put your hands on. So
I have a question.
yes.
What about intangible, like intellectual property rights? How do you categorize those on your balance sheet?
Those would be intangible assets as well. Yes, property rights would be intangible assets. I'm thinking all of those would fall under this particular category. If it's something of value that is not something that you can put your hands on, then normally that would be considered an intangible assets. It's not shown in this example that we have here, but intangible assets are also reduced in a similar way as depreciation affects fixed assets. Intangible assets are said to be amortized, and amortization is the equivalent of depreciation, but it affects intangible assets. So goodwill is normally amortized over 30 years. So each year you would take 1/30th of goodwill and reduce the amount for book value. Other intangible assets may have a different useful life. If that right or privilege that you have under other tangible assets, if it is a 5-year right, then it would be amortized under over 5 years. If it's a 20-year right, it would be amortized over 20 years. But we would definitely expense those items on our profit and loss based on their useful life. Any questions on amortization or intangible assets? Yes, sir, Mr. Bigby.
Is intellectual property also amortized?
Yes, intellectual property is amortized.
And for some of the businesses who may have intellectual property that they have patented, what's the best way to value intellectual property in for book value?
So basically, that value is determined only when it is purchased. So the fact that you've built up some intellectual value, that does not show on your books. It is when you sell that property, the amount that someone else pays for it, it would show up on their books. So it is based on cost. So
I'm sorry. So if I run a publishing company. I think I said that before. So every time I sign a new author, I acquire the intellectual property rights for a novel.
yes.
So how do I put those intangible assets, the intellectual property rights? Because I say this book should be worth $20,000. How do I put those onto the spreadsheet,
Okay,
onto
so
the assets?
yeah. So did you pay the author a dollar amount for those rights?
I paid them in advance. So
Okay, sure.
sometimes it's 1,000, sometimes it's more. So I pay in advance, and then we do a share on the profits, but I also front the cost for all of the publishing. So the editing, the graphic design, the typesetting, the printing, all of that stuff.
So the portion of the amount you pay to them that applies specifically to that right is the value that you would record as an intangible asset on your books. So if that amount is $1,000, then that is what you would record as an intangible asset, the $1,000. The fact that you pay for costs up front, then those costs would be expensed on your profit and loss statement. But that right, because that right has a period of time associated with it, then that would go on your books as an intangible asset, but it would only be for the amount that you paid for it, not for what you value it to be at a specific time. And I'll go a step further. If you turned around and sold that right to someone else for $15,000, then for their purpose, that asset would be valued at $15,000, but it is again based on cost. So whatever it is that you paid for that asset is what you would be recording on your financial statement. Any further questions on intangible assets? Okay, so other assets. Other assets would basically anything else of value that you would have that is owned by your business. It would be something that does not fit into any of these categories that we talked about before. It could be some unusual type of investment or some just other asset, something that we cannot describe in the assets listed above. But with that, our total assets for book purposes for this corporation on December 31st is $770,000. Okay, so the next section is liabilities. And liabilities speak to amounts that are owed by the business to some third party. And again, they're broken down into categories. We have current liabilities, we have long-term liabilities. So short-term liabilities or liabilities that are expected to be paid in the next 12 months. So from December 31st, 23 to December 21st or 31st, 24, the amounts you see in short-term liabilities, those amounts are expected to be paid within that time frame. Then long-term liabilities or amounts owed that relate to liabilities that are expected to be paid beyond the 12-month period. So under current liabilities, we have short-term loans payable, $5,000. We have that loan is set to be paid in less than 12 months. The second item is the current portion of long-term debt. So under long-term liabilities, we have that notes payable and we have bonds payable. Well, this relates to the notes payable. So we are made to record in the short-term liabilities the portion of that note that is due in the next 12 months. So that note is normally split. So that 20,000 in long-term debt and that 15,000 in short-term would probably make up the same loan of 35,000. But of that loan, 15,000 is expected to be paid in the next 12 months. The next item is accounts payable. When you purchase goods, services on account. So you have not yet paid for your supplies. You have not yet paid for your inventory, but it is expected to be paid for your utility bills in the next 12 months. All of those items would be considered accounts payable. Accounts payable would also include any credit card payments to be made. So that would make up your accounts payable. Accrued compensation and benefits. So some businesses allow for employees to earn vacation and say retirement benefits. So any unused vacation would be considered accrued compensation. Any, say you contribute to the retirement plan, the employee has already earned that benefit, but you've not yet paid it to the retirement company. So those would fall under accrued compensation and benefits. Income taxes payable. Those would be, just as they say, taxes, income taxes owed, but that have not yet been paid. Other accrued liabilities could be any other debts that are owed. If you made a personal loan from a relative, that would be other accrued liabilities, okay? Deferred revenue. Deferred revenue would be money that you collected upfront, but you've not yet earned it. You've not yet provided the service. So if you told a client that I need you to give me $1,500 before I start the project, at the point they give you that $1,500, at that point, it is a liability to you because you've not yet earned it. And so once you've earned it, then you would then reduce your deferred revenue and recognize it as earned revenue on your profit and loss statement. In our example, we have $61,000 in current liabilities. Any question on current liabilities?
Not a question from me, but I just wanted to, this is sort of going back to the very, very beginning. Wanted to make something very clear between this and the income statement. Income
Yes.
statements measure a period of time.
Yes.
Balance sheets are a snapshot in time. Just wanted to make that very clear. So you see
Sure.
December 31st, 2023, you're looking at the balance sheet as it is on that day, on the hour it was put together.
Yes.
That's one of the main differences. And so, you look at balance sheets at different times of the year, they can vary pretty wildly. And so depending on the organization, but some of them can vary quite a bit throughout the year. So
Sure.
That's just something
Yeah.
just to make clear for everyone on the call that this is, at whatever, 11:59 p.m. on December 31st, 2023.
Right. And the way I sometimes talk about it is I'll say, how much money do you have in your pocket? And money in your pocket would be an asset. But you wouldn't talk about how much money I had over a week. It would be at the point I'm asking you. So how much money you have in your pocket would be at a point in time. And so when I ask you, how much did you earn this week, which would be revenue, you would say by the hour, you would say by the week, by the month. So when you talk about revenue or earnings, you're always going to state a period of time. I make $25 per hour, a period of time. I make $10,000 a month. Again, revenue and expenses are talked about over a period of time, where liabilities, how much do you owe the bank? And you're going to speak to the point that I asked that question. I owe them $10,000 as of now. So again, the balance sheet is a point in time. Revenues and expenses on your income statement is measured over a period of time. So the next section under liabilities would be our long-term liabilities. And again, these liabilities are said to be paid back over a period of greater than 1 year. So again, we have a notes payable. So that notes payable, we did recognize the current portion of it in our current liabilities, but the portion that is owed beyond 1 year is shown here under long-term liabilities. Bonds payable. So if a business uses bonds to finance its operations or the purchase of equipment, those bonds are basically a loan, a promise to pay back. And so those bonds are normally stated over a period of time in which they would become due. So in this example, these bonds are not due in the next 12 months. They are due at some point beyond that 12-month period. So the 375,000 in bonds, you could expect that they are not to be paid anytime before December 31st, 2024. Deferred income taxes. And so this relates to that difference between book purposes of your financials and tax purposes. So for book purposes, when you choose to take accelerated depreciation on your tax return, you are basically pushing taxes down the road. And so we have to recognize the amount of taxes that you have pushed forward. And so those are considered a long-term liability. It's an amount that you're going to pay back at some later point. So you took the benefit today, but down the road, it's going to catch up to you. You're going to have to pay the taxes that you did not pay earlier. And so that amount is recognized and it is considered a long-term liability. So in our example, we have deferred income taxes of $25,000 to be paid at some point beyond the 1 year mark. So our total long-term liabilities is $420,000. Our total liabilities is $481,000. And so banks want to look at basically the difference between what you own, the value of what you own, less what you owe, and that remaining portion is your ownership in the business. And your ownership in the business is considered your equity. And so in this particular example, we have several line items that make up our equity. So the first portion of equity of this corporation is common stock. Common stock is basically shares that are sold to individuals, to entities as ownership in the business. So this business has outstanding common stock of $110,000. This had, you could basically say at some point can increase in the value of the stock can increase, but it's again recorded at cost. So you could say individuals purchased this stock for $110,000. That does not mean that that's the value of the stock at this given point. Retained earnings. Retained earnings is the accumulation from inception of this business all the way to December 31st of profits or losses over that period of time. So each year, we will close out our profit and loss statement. If it's a gain, if it's a profit, we're going to increase our retained earnings. If it's a loss, we're going to decrease our retained earnings. But that number represents the cumulative earnings less expenses of this business from inception to December 31st, 2023. So to date, this business has a profit of $220,000. Okay. Accumulated comprehensive income. That would just be other income that's not normally associated with the operation of the business. It could be, if this business, like for example, it has investments, this could be what we would call unrealized gain on those investments. And so it's not recognized gain, but it does represent an increase in your equity. And so those accumulated comprehensive income in this example would be $9,000. The last item in our equity section is called treasury stock. Treasury stock is basically the business buying back its own stock. So it issued stock, so many shares of stock, but at some point the business say we want to buy back some of our shares. So again, recorded at cost, this business bought back $50,000 of its stock. So that reduced its the shareholders' equity in this particular business. So in total, the shareholders' equity here is $289,000. So there is a basic formula in accounting that says that assets equal liabilities plus equity. So in any given situation, when you add your liabilities and your equity, they should equal your total assets. And you can see that, and that's the reason it's called a balance sheet. So again, you could turn this formula around. You can say assets minus liabilities equal your equity, your ownership. So basically, your balance sheet is always going to reflect that equation. Assets equal liabilities plus equity. Any questions? Mr. Big.
Just to add, I mean, you're not going to see, for the businesses that are on this program, of course, most are not going to have common stock and treasury stock. But a lot of the other elements that we talked through today are relevant to the businesses you're running. It's really important, even as an early stage business owner, to understand how the profit and loss and the balance sheet work, and what they do, because anytime you approach a bank, especially when you're looking to get some form of financing, they're going to ask you for this. And when it comes time to preparing taxes, financial statements, it's really important to have a good understanding of these two statements, because at some point well, it's important from the get-go, but it's important that as a business owner you understand these, and usually as your business grows, your understanding of these statements deepens, hopefully, because you're learning about new things, you're working with your bookkeeper, your CPA, and you're growing your knowledge of these statements as the business grows. But really important to have a basic understanding of these statements, which is why we teach this on the program, and why we also offer businesses free assistance in putting financial statements together. So just wanted to add that I sent out the link. Stop sharing here. I sent out the link yesterday, and I'll put it in the chat again, but we have bankers that work with us who are giving their time to the program, who can assist with putting financial statements together. So if you are interested in that, I'm going to put the link in the chat. As I said in my email, there are not a ton of bankers who volunteer to do this, so we are a little limited. We prioritize this resource based on attendance at learning, so congratulations. And I take attendance at every session, and so I know who's been engaged with their mentor and engaged with the learning on this program. This program is very much based around the principle of the more you put in, the more you get out. And so, please, if you are interested in updating, even just creating an update of your financial statements, brushing them, creating them from scratch, fill out the link, and I'll get you connected with somebody as soon as I can. So just wanted to jump on that. If you're panicking and worried about how do I even start with financial statements, we have a great resource for that on this program, which I'm very glad we can share with everyone. So that's really it from me. Any questions, comments? I know that's a lot of information, and you feel free to talk about it with your mentor. You can reach out directly to Leo if you have a very specific question that you don't want to talk about on this call.
I did have one more question.
Yes.
So say I plan on doing a large event and I start stockpiling inventory, does that inventory depreciate over, does the inventory start depreciating if the event gets postponed, or does it still retain its value?
Normally inventory does retain its value. It is normally considered to be a current asset, and the expectation is that that inventory should turn over within 12 months. But I do know that inventory can become obsolete. And at whatever point your inventory would become obsolete, you would need to recognize that and reduce your inventory by expensing the portion that is considered to be obsolete. So inventory does not depreciate, but it can become obsolete. And at the point it becomes obsolete, it should be fully written off at that point. That answered your question. And one of the things I will say in closing is that there's software packages available that if you take the time to actually learn to use the software properly, it can serve as a great guide in presenting or creating both your income statement and balance sheet. But it is only a tool. So if the information is not entered into the software properly, then the end result will probably not come out as it should. But to the extent you can actually learn to use the software properly, those statements are definitely a part of the software. And so it becomes a matter of printing the statement once you recognize how to use it properly. And then even once it's printed, you still need to review that statement to make sure that statement reflects accurately what it is you're trying to show as it relates to your business. But it is extremely important that you maintain financial statements that are both timely and accurate. Financial statements that are 6 months old are normally not of very much value to any third party. Most times they would like something that is as current as the last 3 months. They may ask for last year's as well to look at a longer period of time, but they are always going to ask to see something that is fairly current. So it's important that your statements be both accurate and timely.
All right. Thank you so much, Leo. I'll see you again at 1 o'clock for
I'll see you
next
then.
balance sheet session.
Yes.
And thank you everyone for joining this morning. I hope it was useful. Happy holidays. I will see you all on Tuesday next week when Leo will be talking about tax filing and tax preparation for businesses. So please don't miss that. Very, very important session, as they all are. So yeah, thanks everyone. Take care. Bye.